Welcome to week 6, module 2, and we're going to cover my favorite retirement plans, because for a financial planner, these are the types of plans I'll probably be working with, because I'll be working with smaller companies. I realize I can't compete against Vanguard or Fidelity, but I certainly can compete against them at a client that has 20 or 30 employees, because let's face it, Fidelity and Vanguard consider that chunk change, and to me that's a nice sized company. So I will have people who have one employee, maybe husband and wife, to where the largest I've dealt with is 250 employees. And these plans fit very well for that. In addition, we're covering some governmental plans, the 403B and the 457, which are designed for governmental and schools, not-for-profits, very specialized areas. And I've found that a lot of financial planners are in these areas. Never could figure out why, but I've had classes where a good preponderance of my students were either pushing 403 plans or 457 plans. So I think there's probably one or two of you in this course who probably might be in the same position. So let's take a look at what we got. SEPs. Been around for a while. Simplified employee pension. And now ordinarily when the government says simplified, it scares. I run the opposite direction. It's like when someone offers me 12% return on investment, I run the opposite direction. But when the government says simplified employee pension plan, they actually mean it. And when it first came out, I was kind of scared of it, because how can the government call anything simplified? But it is. It's an employee-sponsored plan in which plan contributions are made to participating employees' IRA accounts. Now, it has changed over years. And if you've been around for a while, you may have been involved in one of these even, where you were allowed to put your money in. Today it's only the only the employer can put it in, and it goes into an RIA. Tax deferred contribution levels are generally much higher than the maximum contributions to traditional IRA, so that is a big advantage. And again, it's an index value, so you can look in your book to see what it is for this year. Again, subject to change by Congress. You can always do it retroactive for the year. Since 1997, all new SEP plans are employer contributions only. Before that, it was much different, and it was much more flexible. But what happened is a lot of employers went to going from employer paying to strictly employee paying, and that's where the problem came in, and the government overreacted and made it, you have to be employer only money. Characteristics, again, this is primarily from the IRS. You can set up the plan to April 15 tax date. Again, makes it a lot simpler for the company, because everybody knows what April 15th is. They're not going to forget it. There's not a magic October date or July or something. It's a lesser of index value or 25% of compensation, so it's a significant amount that could be put in, and it's fully vested from day one, which the employees love. They don't have to worry about whether they're going to lose it or not. And again, small companies have a terrible record of going out of business, but you can save for retirement. Even if your business goes under, you can take that money with you. Disadvantages: loans by participants are not allowed. Now, that's the IRS. To me, I don't want participants taking loans again, because they're taking away from the retirement. And who's going to pay for the retirement? There's not enough money provided by Social Security to support most people. Coverage required for all employees who exceed an index minimum wage, so that everybody gets a share. And I like this idea too, because I worked for a company where they had like 50% of the non-highly compensated were getting in a retirement plan, the other 50% didn't, and they really felt like they were discriminated against, and to the point where people are talking about unionizing or quitting the company because they were not in the retirement plan. And yet the company was fully qualified because of the way they complied with the law. So in this case, everybody gets it. There is no over 50 catch-up clause, unfortunately. And if no other plan is being used, Form 5305 SEP is used. Now, sometimes there are other plans, but again, this is designed as a standalone plan. Very simple to fill out. Even I can fill out the forms without any training at all. It's a matter, especially the forms dealing with the employees, and if you go to the IRS, you'll see those forms. Again, it's simple, it's straightforward. The amount of paperwork required by an employer is a minimum. It can all be done by the trustee. So obviously I love it, right? We have a simple IRA. And simple doesn't mean simple in this case. It means savings incentive match plan for employees. I wish they wouldn't use simple. The simple IRA actually has less paperwork requirements than the simple 401k plan. It's hard for me to say simple when I deal with these because these are not that simple paper-wise. Much prefer what we just talked about. Many of the advantages of qualified plans for employees, except the contribution level is lower than qualified plans. And again, it's designed for small companies. Portable for employees, that is immediately vested, just like the SEP. And that we cannot have another plan for employees covered by the simple IRA. So if you have a simple IRA, that's the only plan. Characteristics, advantages, deadline is set up October 1st. Well, I don't consider that an advantage. April 15th I can remember, December 31st I can remember, but October 1st, why? I can only say ask Congress. Contribution limit is $12,000 plus employer match up to 3% of compensation, and this is not indexed, which means it's not a lot you can set aside, and by the employee, and then the employer can match up to 3%. Over 50 catch-up indexed, so if you're over 50 years old you get a little bit more you can invest. It's fully vested. The disadvantage, there's no participant loans, and again to me that is an advantage but not to the IRS. Must cover all employees earning over $5,000, at least 21 years old, and work for the employer 3 of the last 5 years. Well, for a simple company, a small company, that's pretty easy to figure out. But if you're talking about 75 or 80 employees and there's a little bit of turnover, yes, it could be a little bit of calculations you have to do, and etc. It's limited companies with less than 100 employees, and no other plan is allowed covering the same employees. So, again, very common plan, a little bit more complicated than the SEP. We have the simple 401k plan. We had a simple IRA, now we have a simple 401k. I almost can say that with a straight face, right? Meets the non-discriminatory requirements of Section 401A(4), thus is not subject to the testing of the ADP. It's exempt from the top-heavy rules, and that might tell you something, subject to the reporting, disclosure, fiduciary responsibilities, and other requirements of the 401k plans. Now, that means you're going to have a lot of paperwork to file. Characteristics, advantages, employer contribution required equal to dollar up to 3% of compensation, or non-elective contributions of 2% for all eligible employees, whether or not they elect salary reduction contributions. So I can do 3% to do it, or 2% for all employees. We have catch-up after 50 years of old. It's fully vested, and employee can make salary reduction contributions. So, and that's, again, primarily employee-based as opposed to the IRA. And in this case, the employer can match 3% or 2%. So it's pretty straightforward. 100 or less employees with $5,000 a year in compensation last year. So you had to be here in the previous year and earn $5,000. More documentation and administration than the simple IRA, SIMPLE. So I can't even, it's got me so shook up I can't even spell it. It's more documentation, yes, it's more complicated. Not as bad as a profit sharing plan or a defined benefits plan, but it's still a lot for a small company. And I would suspect that a lot of the employers who use it are disappointed because of the amount of time it takes. We also have what's called the solo 401k plan. The IRS pushes this one for some reason. One-person companies can use a plan in which the sole owner can elect the salary reduction up to an index amount, plus there's an over 50 catch-up phase, and the company can then contribute an additional amount up to the deductible amount of 25% of compensation, up again to an index amount. Much more can be contributed in the use of a SEP, a simple other plans designed for small businesses, which makes it very attractive for sole proprietorship. And we can accept the plan by the end of the plan year, which again, I much prefer April 15th or December 30th, but this is probably in most cases going to be December 31st. Loans are allowed, which I don't like. Again, for me, that's not an advantage. You can set age and service requirements and match contributions. That's good because I can now try to help the people who need it the most, which are the older people. There's catch-up for over 50 index, and there's no employer limitations. The disadvantage, it's $17,500 plus matching contributions. It's graduated vesting for employer contribution, 20% after 2 years, 40% after 3, etc., to 100% after 6 years. So vesting is an issue on this one. Again, that makes it a little bit more complicated, right? But it's a little bit more money also that can be put in. SARS SEP, they're still around, a lot of them. In fact, I was in a class and I mentioned that we're not going to cover SARS SEP in this class because they're obsolete. And I found out two of the people in the class actually had SARS SEPs. These were great plans that were set up before January 1st, 1997. At that point, you could not start a new one. But if the company has been around prior to January 1st, 1997, and it's small, very small, it probably has this kind of plan. Some of the companies have grown out of the plan and therefore had to go to something else. But there's still a lot of companies that have 10, 12, maybe even 3 employees. Prior year, less than 25 employees. I mean, last year, if you had less than 25 employees, you qualify. And today, if your employees go over 25, you have to stop the plan. At least 50% of all employees must participate, maybe combined with other type of retirement plans, which is good. There's a special ADP test. The deferral percentage of each highly compensated must not exceed the ADP of all eligible non-highly compensated employees multiplied by 125%. Again, there are still plans around this, and you should be aware of it. You cannot start a new SARS SEP. And characteristics of SARS SEP: maximum contribution is $17,500 plus matching contributions. Again, it's an older plan, so it's not been indexed very well. In fact, it isn't indexed. Indexed over 50 catch-up. It's fully vested. Must already exist since 1997 or earlier. No new plans are allowed. There's no plan loans. Must cover all who earn a nominal index amount and limited to 25 or fewer employees. Again, this is the SEP came out of this, and SEP basically replaced this plan. And sometimes you may be asked on the CFP exam, what's the difference between the two, and you have to know it, and that's why we give you the advantages and disadvantages as set forth by the IRS, so that you can make this comparison. The 403B plan, typically referred to as a tax-deferred annuity plan or tax-sheltered annuity plan, as well as 403B plan. And I've heard people say, well, I offer the tax-deferred annuity plan, I offer the tax-sheltered annuity plan, and I also offer the 403B plan, so I can solve all your needs. Well, it's all the same plan, different names, and again, the only legal name is called Section 303B because that's Section 403B of the IRS Code. Only tax-exempt employers and educational organizations can adopt this plan. So if you qualify tax-exempt, and that against IRS determination, or you're an organization or institution can adopt this plan. A self-employed licensed minister of a church who works for an employer that is not a qualified tax-exempt organization is treated as working for such an organization for purposes of participating in the plan. So let's say that we have a person during the day, he's a carpenter and he also is a minister. Is going to be treated as working for the ministry for purposes of participation in the plan. 403 plans, advantages can be rolled over to another plan maintained by the governmental agency or to an IRA. Funded by employees, however, an employer can contribute. 100% vested. Employee salary reductions limit the index amount. There's a unique catch-up is allowed. You're going to have to look that one up if you're interested. Hardship withdrawals and loans are allowed. Disadvantages offered, it must be offered to all employees regardless of age, service, or union affiliation. Not qualified but has some ERISA restrictions, and investment limited to annuity contracts, mutual funds, and life insurance. And you think about it, for most people with IRAs, you're going to stick it in mutual funds. Of course, you're not going to use life insurance if you have an IRA because it doesn't allow it. But certainly it's a good idea, and I can't argue with using annuity contracts either. So it says it's limited, but I think it's really pretty good for clients because it takes the mutual funds can provide for diversification, insurance, and annuity, again, a safety valve. So I think it's a really good plan. Remember that this is not the federal government, this is state and local government when you talk about government agencies. And again, the federal government cannot tell the agencies what they got to do, but what they can tell them is if you want to get a tax advantage for federal government, here's what you got to do. So they're not qualified plans, they have their own sets of rules which Congress has established for them, which is confusing to a lot of people when they talk about, well, why is the state of California or city of Los Angeles or the city of Thousand Oaks plan different than plans offered by companies? The reason is there's less control that the federal government has over the sovereign state of California and its subsidiary cities of LA or Thousand Oaks. The 457 plans, also very common. They can be offered to all, a single group of employees, only a department, or even a single employee. Extreme flexibility. This sounds like really a non-qualified plan, which we'll be discussing in the 7th week. Only applies to state and local government employees and employees of tax-exempt organizations, except for employees of religious organization. So the easiest way to remember this is, yes, indeed, it applies to same as the 403, except religious organizations are left out. And don't ask me why religious organizations are left out. Ask Congress. ERISA only applies to the non-governmental tax-exempt organizations. Why? If it's governmental, the sovereign state of California, New Jersey, and New York is not subject to federal rules on how they do things within the state. But the federal government can say, if you want to have tax deferred, ABC, but they do not apply the ERISA to it. I wish they did, because quite honestly, a lot of these funds are way underfunded. And that's the next point, no funding reserves required of employer. And again, there's a tendency for government agencies to go out and give it to the employees and not pay attention to having any funding set up for it. And then the only time you worry about is when you finally have to pay the employee, and of course, then I guess you do like Detroit and declare bankruptcy. Plan distributions cannot be made before age 70.5. Severance from employment or emergencies is defined in the regulations. Again, much more flexibility with 403 and 457 than with qualified plans or the small plans we discussed in module a little bit earlier. Let's talk about the big advantages of 457. Amount deferred annually by employer cannot exceed the lesser of 100% of compensation or an index cap. And typically it's going to be the index cap would be the lesser. Catch-up clause for government employees over 50, also 3-year catch-up clause for all in last 3 years of employment. So it's kind of interesting. If you know ahead of time you're going to retire in 3 years, you can get a special catch-up under 457. There's a one-time distribution during employment is allowed under certain conditions, which is, again, not going to be penalized, which is nice for the employee. However, in the long run, it's bad because they're not saving for retirement. Loans are allowed, which I also don't like because it takes away from retirement. Disadvantages for the IRS standpoint: unfunded assets allowed in the reserve fund, and that's a problem for me too, because I don't want more Stocktons and Riverside, San Bernardinos, Detroits, and whoever's next where they don't have enough assets. Maybe it's the state of California, the state of Illinois is next to say, okay, we don't have enough assets to pay the funds because we didn't save anything. Mandatory cash outs required under certain conditions, and that's basically small inactive accounts. And if I recall, it's something like $2,000 or some amount. And this is, again, someone works for a school district or a government agency or not-for-profit, leaves, and the amount that's in their retirement plan is $1,500 or so. it becomes administrative problems because you got to keep track of this for maybe 40 or 50 years until a person retires. So they have if it's under that certain value, which I believe is $2,000, they just give you the cash, get it out. I think it'd be a smart idea if companies could do it too, because I have seen where companies have had benefit plans where a person has stayed 8 to 10 years with the company. They left when they're 30 years old. They don't get it till 72, and they got to keep all this records for someone who's going to get a very nominal amount because he doesn't meet the key criteria: age, the years with the company, and salary with the company. So there probably should be a mandatory cash out in those too, although for, I guess, political reasons they don't do it. That ends our topic for today.